Hi, Raj.
Hey, Kyle.
You're the founder and CEO of Storyboard Living, a real estate investment company. Your portfolio of multifamily assets, self-storage assets, and a few commercial properties, it's in excess of 9 figures. You're in your early 30s, and you've been the only equity.
We're a growing company. We've been on the Inc. 5000 list and the St. Louis Business Journal Fast 50 list 6 times.
When did you make your first leap into being an entrepreneur?
So I moved down in May and acquired, the first asset. It was a $13,000 mobile home. So I made all the mistakes there, literally. Did the renovations myself, and I'm not a handyman. Moved someone in because they seemed like a nice person, no background check. I'm personally more willing to take risk with my own capital than I am with investor capital. And yeah, it's because I care. I don't want other people to lose their money betting on me, but it's also because I would not be able to sleep if people were calling me and saying, hey, where's, the couple $100,000 I invested with you? Why'd you screw that up?
Hi, Raj.
Hey, Kyle.
How are you?
I'm good. How are you?
I'm good. So thanks very much for hosting me in your office on Country Club Conversations. Today, we're going to have a fairly unorthodox episode, but one that I think is incredibly important to do. And so thanks very much for having me, and thanks for letting me take an hour and a half, whatever it winds up being of your time, to really talk about your story today.
Well, thank you for wanting to do this. I thought it was a great idea, and I do appreciate the thoughtfulness, and I'm looking forward to it.
Yeah, okay, let's do this. I'll admit this is my first time hosting a podcast, but in January, I had the pleasure of coming on to your podcast. And that was actually the first time I had been a guest on a podcast too. And it struck me while we were talking together on the podcast about how important your story is, and how I should have probably been the person interviewing you or asking you questions rather than the inverse. And after we did this in January, I reached out and said, hey, Raj, I've been thinking about this, and I have an idea. I want to interview you. And you were so generous and said, yeah, let's do that. So thanks very much. You're the founder and CEO of Storyboard Living, which is located here in the Metro East, Fairview Heights. I think you've got a really wild, in an interesting way, story, and very impressive. And I think any parent should be really proud of you. So what originally brought you to St. Louis? Well, let me take a step back. So Storyboard Living, so you're a real estate investment company. You have some affiliated companies that help you manage construction and property manage and things like that, right?
Yeah, that's correct.
Okay, and you've got a team of about 25 people.
Correct.
And what I think is really impressive, just to kind of set this table, is that up until very recently, your portfolio of multifamily assets, self-storage assets, and a few commercial properties, it's in excess of 9 figures. So you've created a large company for yourself. You're in your early 30s, and you've been the only equity.
Correct. Yeah, up until very recently.
Yeah.
Yep.
Which is super unique, and one of the reasons why we're here today. So also what's interesting is that we're in the St. Louis MSA, but you're not from St. Louis. Where are you from? How did you get here?
Sure. A lot of people ask that question, and I think it's a question that hopefully 10 years from now, no one's asking, because I do think St. Louis is going to be the next Nashville, the next Austin, the next growth story, where there's people from all over the country relocating here. I'm from Brampton, Ontario, a suburb of Toronto. It's a middle class, kind of working class suburb. I would say roughly 80% or so of the folks in Brampton are first-generation Canadians or immigrants. I know that was the case in my neighborhood growing up. So that's where I'm from. My parents were immigrants to Canada. I'm an immigrant to the U.S., so there's a pattern there. They kind of have the typical immigrant story in Canada, at least, and I'm sure in the U.S. they immigrated to Canada with $5 in their pocket. built a life for themselves and their family. Gave my brother and I a solid middle class upbringing. Nothing outrageous, but we also lacked for nothing. We had everything we needed to put ourselves in a position to be successful one day.
Yeah, no, that's great. So, I did a little bit of research on Brampton. So it's maybe 20, 30, 25-ish miles from downtown Toronto. It's about, you said, oh, I'm from a suburb of Toronto. And then I looked and there's 655,000 people that live there. And like you said, it's got a large concentration of immigrants. And so what was it like? What did your parents do? I mean, what was it like in your household as you were growing up?
So my parents have a really interesting story. They grew up probably what we would call like lower middle class. My dad grew up in Punjab, which is a region in northern India. Our background is we're Sikhs, and being Sikhs, we make up less than 2% of India's population. So minority there, minority in Canada, minority here. It doesn't matter where we are. My dad, he grew up farming. Our background is it's really agriculture with a little bit of military sprinkled in there. So my dad grew up farming and going to school. He didn't have the opportunity to really do any post-secondary education. He needed to start putting food on the table. Same story for my mom. She grew up in England, but she grew up in kind of a similar situation where she had to start working at a young age. So when they immigrated to Canada, they were working like factory jobs, labor. My dad eventually started driving a truck. The trucking company that he was working for at some point was close to going out of business. And I'm sure his future partner is listening to this, so I won't go into too many details because I don't know the full story. But basically, my dad was able to buy into that trucking company, and he helped, along with his partner, to turn it around and to make it successful up to a certain point. And then they faced some challenges, which is when he ultimately left. And that was around 2008, the major challenges they were facing, which a lot of people were facing. And my mom, she was an early childhood educator after working some of the, whatever jobs that she could get type of situation. And then she put herself through college when my brother and I were in elementary school. And then she started working in kindergarten classrooms in the Peel board, which is like the school board in that part of the world.
Okay. Yeah. So you have one sibling. Is he still in at home?
Yeah, so my brother Jesse, he moved to St. Louis about a year and a half ago, and he's helping to run the self-storage side of the business, along with a childhood friend of mine, also from Brampton, who moved to St. Louis about a year and a half ago. So Storyboard is very much focused on acquiring apartment communities, but we're building up like maybe a second division, if you want to call it that, on the self-storage side.
I mean, that's really cool. So already, and your wife is from your part of the GTA, and not Grand Theft Auto, but Greater Toronto Area, right? As it's called.
Yeah. So, where'd you learn that?
The internet.
Okay. So my wife Jazz, she's also from the GTA. She grew up in Mississauga, Ontario, but her neighborhood that she grew up in was very similar to Brampton in terms of financial and racial makeup. So we come from very similar backgrounds, and that helps us today just in terms of, like, for example, the vast majority of whatever's coming in the door is being reinvested in the company. So we don't have expensive tastes.
Sure.
There aren't the desire to own a private jet is not there. So it helps that we're aligned.
Oh, that's great. And did you meet in Canada or did you meet here?
Yeah, we did. Okay. So we got married. We were long distance for a while I was here, and we got married in 2015. So about 9 years ago now.
Yeah, you got married early, but you have 2 children. We'll get to that in a little while. So what I already am happy about is, you moved here, and we'll get to that story soon. You moved here, and now you've brought multiple people here, and it seems as though, and you're really growing a company, which is really awesome to see. We need more people like you moving here. So how you found your way to St. Louis is really interesting. But did you go to college?
Yeah, I did. So I say college because everyone here calls it college. And I feel like if I say university, it sounds pretentious. But in Canada, there's a clear distinction between college and university for whatever reason. I think it's the same in the UK. So I went to a school called the University of Guelph, which no one here has heard of. It was one of two schools where I could have majored in real estate and housing at the time. I think now there might be 3 or 4 in Canada where you can major in real estate and housing.
Okay.
So that's where I went to school. The focus clearly has always been real estate, and my interest in real estate, I think, was really sparked when I was a teenager, and I knew I wanted to be a somebody one day. I just didn't know how, and the people that you would see in the media or whatever that were successful entrepreneurs were typically in real estate. So that was the common thread that I was seeing at the time.
Yeah, and so then you decided that you were going to pursue learning more about that in college. Okay.
Yeah.
And so then you graduated college, and you said, the American dream. You want a piece of that. You want to get in on the American dream.
Yeah, that's correct. So there is a quote that I want to share. It's from Sam Zell, a guy that I think most real estate folks are familiar with. Mm-hmm. And this is Sam Zell, not me. I didn't come up with it. My life is dedicated to the idea that I'm part of the great American dream, an entrepreneurial movement like no other in the world. I want to find great opportunities no one else sees, solve problems others can't, turn around broken assets, and grow great companies. That sums up the American dream for me. It's very much centered around entrepreneurship for myself.
Yeah, that's great. So did you read that whenever you were still in Canada before you moved to the States?
I don't know if that particular quote was one that I read at the time. I might have, but I didn't really resonate with that quote until more recently. It was maybe a couple years back where I read "Am I Being Too Subtle?" again, and it just perfectly summed up why I'm here, why I feel like the opportunities in this country are like no other on the planet, and what propelled me to want to be here, even if I couldn't verbalize it at the time.
Yeah. So, and one of that's really interesting. Thanks for sharing that quote. And whenever I was looking at the map, trying to figure out exactly where you were relative to Toronto and Toronto relative to the United States, then you see, okay, Detroit, Rochester, Syracuse, Cleveland. You could have selected any of those cities to go to, be a part of the American dream on the south side of the border and be closer to home. But you decided to move much further away from home in the middle of the Great Plains of Illinois. And tell us about how you wound up in Highland, Illinois, a town of about 10,000 people, so substantially smaller than anything in the GTA. And it's about, 30 minutes or so east of downtown St. Louis, which probably kind of got your foothold into St. Louis. But So how did you find your way to a 10,000 person town in the middle of Illinois?
There's a long version of that and a short version. I'll find the middle ground.
Yeah.
I'll find the middle ground. And the reason for that is a part of it is our relative in Highland. He has his own extremely interesting and unique story. I just don't know if it's my place to tell his story. So I'll say we had one relative, our family did, that I never met myself in the U.S., and he was in Highland, Illinois. He found his way there, again, through, it took him a while to end up in Highland, but he ended up in Highland. And he was kind enough to allow me to stay with his family. I helped him out a little bit he has a gas station in Highland, and today he has probably 4 or 5 in that part of Illinois. So I helped him out at his gas station, and I was able to live with him and pursue what I wanted to pursue, which was looking for real estate opportunities, and then also making connections with people that could either guide me or help me in finding those opportunities, executing on those opportunities. So coming to Highland, it wasn't necessarily the original plan, but it ended up working out that way. And I stuck around in the St. Louis region because I think this is the most underrated region in the world. I really do. I think this is going to be discovered one day, and I want to be a part of it. And
I appreciate you for that. Yeah, we're aligned.
And there's a lot of great people like yourself in St. Louis that are passionate about the city, the region, and want to see it succeed. And you don't find that just anywhere. And being able to access high level people, I think, is easier here than it is in a big city like a Toronto. I think, generally speaking, the business community is more welcoming than it is in a sharky environment like Toronto. So I saw a lot of stuff that made sense to me in terms of being in St. Louis. But one of the things that really pushed me away from Canada was I saw at the time, and it's, in my opinion, gotten a lot worse today, 10, 11 years later. I saw it going in the direction of a UK or other European countries, to where it's extremely hard to build a mid-sized company unless you're connected, unless you come from a lot of wealth. There are a lot of really big companies in Canada, a lot of really small companies, but not a lot in the middle ground, at least compared to the US. A lot of it has to do with the community banking system here. It doesn't exist anywhere else in the world except for maybe Germany, the way it does here. And it makes it possible for entrepreneurs like us to access capital and take risks with partners, lending partners that really understand what that risk is like, because they're in those local communities, what that level of risk truly is.
And it's a relationship at that point too. I mean, it's a real relationship.
Yeah, agreed. So just going back to the question about ending up in Highland, I graduated from university in 2013, just turned 22. I came down to visit a relative with my dad and my brother. It was like a 13-hour drive. Prior to that, the only other place in the U.S. I'd been was Niagara Falls, New York. Yeah. So, as we're driving down, I was like, "Where the heck are we? Are we in the South?" I didn't know where we were, and even today, I mean, maybe you can argue St. Louis is in the South or right on that border, but I thought we were like in the deep South. I didn't know where we were, and after visiting our relative a few weeks later, I moved down permanently.
Okay. You said something really interesting about, like, am I in the South? Like, where exactly am I? And so I've heard, I can't remember which publication said this, but it was like a travel publication, and the author said St. Louis is best described as the westernmost East Coast city and the northernmost southern city. And I think that's really true culturally, the way that the city itself was laid out, things like that. So that's interesting. Okay, so you made it. So you came down, visited with your family, you decided, then you met your family member, you decided, like, okay, this is where I'm going to open up shop. I'm going to be an entrepreneur here. Yeah. And how did you take your first, when you relocated, were taken in by your family, when did you make your first leap into being an entrepreneur?
Yeah, it was a couple months later. So I moved down in May, and probably by July, acquired, the first asset, which is not the type of asset Storyboard would target today. Sure. But it was a $13,000 mobile home. I found that through a relationship I made in Highland with a real estate broker there he was like 80 years old, and I felt like it was someone I could learn from, and he enjoyed my company. So I spent some time with him, and he sold me a mobile home that he owned for probably 30 or 40 years. It was really beaten up, and it was rough. Yeah. So I made all the mistakes there, literally. Did the renovations myself, and I'm not a handyman. Yeah. Moved someone in because they seemed like a nice person, no background check. Yeah. Let the person stop paying rent without starting the eviction process within a reasonable time frame, because I was buying excuses. And then when the time came for the eviction to take place, he was arrested. So in court, he was escorted, in his orange jumpsuit and, all that kind of stuff. So I literally every single mistake I could have made, I made there. And then once he was evicted because he was in prison, well, he was in jail and he was going to prison. He was going to be gone for a while. He might still be gone, unfortunately, or maybe fortunately. I don't know.
Yeah, I hear you. Yeah.
I had to empty out the mobile home, right, of his belongings. He had somebody come and like take a few things, but the weirdest thing, he had an entire room, floor to ceiling, filled with broken televisions. Apparently, I don't know if this is a thing or not, but apparently and they were all smashed. He was like smashing them, taking something from inside the televisions and selling it. So there was, broken glass and whatever in there. And at the time, for the first few years, I was very focused on not spending, like keeping expenses in check with the operations of anything. And this thing was already was already a loser. So I didn't want to spend more to hire somebody to clean it out or whatever. So I cleaned the mobile home out. And I remember just thinking at the time, like, what the heck am I doing? I'm a big failure. I don't know what I'm doing. I'm in America. Maybe I should go back to Canada and get a job or whatever. So that was just a moment that really stood out to me, and it was only a few months in.
Yeah. So what made you not? What made you stay? What made you dig in deeper and continue pushing and believe in yourself? Like, was it your parents or the relative you were staying with? Like, where did you find the source to just keep moving on, the motivation?
Yeah, I think so. And we'll get to this in a bit. Like my parents placed a big bet on me. So I have, and I had that support, like in terms of, I know there's people that believe in me, but a lot of what I do and a lot of what propels me forward is I just have like an internal drive. I have this desire to take advantage of the opportunities in front of me because there's no guarantee that they're always going to exist. There's no guarantee that future generations of my family will have these opportunities because previous generations didn't. So I just have that. And I'm sure you have it too. And it's hard to describe. I'm going to figure it out.
Yeah.
No matter what.
Yeah. You have to win. Yeah. You just keep going until you win. And you're going to lose sometimes.
Yeah.
But you don't let it get you down in perpetuity. Maybe take a day, but then get back
Sure.
up there. Okay. So you had your mobile home, 13 grand, sweat equity, you did everything wrong. And then you started to do things right. What was the next step? And how long did it take after, from the date of your acquisition of the mobile home? So how long until your next acquisition?
I had a couple going at the same time. So
Okay.
Those were single family fix and flip type of deals.
Okay.
And by then I met a pretty good contractor that was able to, do the work I couldn't do. So I did 2 single family fix and flip deals. I sold the mobile home as well, by the way, after renting it out again to a resident that was paying rent and things like that. I sold that. The single family fix and flip deals were like cosmetic rehabs. Bought those, sold those, and then in September or August, I think it was September of the same year. So I'm moving rapidly, and you'll see a pattern as we talk about the journey. It's constant progression and doing things. So in September of that year, the same broker in Highland sold me an 8-unit apartment building that he owned there. It was a pretty good deal in terms of the basis and things like that. Rents were super low. Rents were like $400 a unit. There were 2-bedroom, 1-bath apartments. Wow. So it was a pretty good deal. And that's where I started to figure out, and I think we paid... I know I said I wasn't going to share numbers, but I'll share on these ones because they're no longer storyboard assets. I think we paid like $300,000 for it.
Okay, for 8 units.
Yeah. So that's when I really started to realize that there's a lot of levers you can pull outside of physical improvements to improve the NOI of a real estate asset. Mm-hmm. So, better leasing, better customer service, better maintenance, better marketing, things like that. Yeah. And then that deal... I ended up selling a year later, so I held that for like about a year. But the first, what for me is a big asset in our industry, it's probably a small asset, but it's the type of asset that Storyboard really focuses on today. It was a 64-unit townhome deal That came through a broker relationship, and that was at the end of 2013. So call it like December, going into January 24. I found that in October through the broker relationship, but we didn't close until it was December, January. So that deal was a new construction deal in Muscuda, Illinois. The broker that helped me out with that deal, and I have a great relationship with today. We've done a ton of business together. His name was Paul Murphy. His name is Paul Murphy. Paul's still active. He owns Barbara Murphy Group. They're the largest commercial real estate brokerage in southwestern Illinois. And Paul, if there was a Paul in Toronto, I would not have been able to speak to Toronto Paul. But St. Louis Paul, I was able to talk to almost on a daily basis. And I learned a lot from him. And he was very generous and still is very generous with his time.
Yeah.
So he brought me that deal, and I needed to figure out how I could buy something like that, because by that point, I was really leaning towards the smaller stuff doesn't make sense. I'm going to be working, forever to and exposing myself to a variety of different risks to try to make what I viewed as, not a great reward on the effort. So the focus was shifting towards apartments. I was able to tap into my parents' home equity line of credit for the equity piece. And that's what I mean when I say they placed a big bet on me. That's the type of bet someone places on you that you're gonna run through walls to make sure that it pays off for them. Mm-hmm. So there were a couple things that allowed that to happen. One, the real estate prices in the Greater Toronto Area, or GTA, have probably 10, 15x'd over the last 30 years. So even 10 years ago, you're talking like if you bought something for $100,000 in the 90s, it was probably worth $700,000, $800,000 10 years ago, and today it's over $1 million easily. Yeah. It's just been insane for a variety of reasons, which I can get into at another time. Yeah. And then also at that time, which is not the case today, the U.S. and Canadian dollar were trading at par. Okay. So that helped as well. So that was the equity piece on that deal. The debt was challenging because I was an unknown commodity. No local banks really knew anything about me. They didn't understand the vision. So I worked with a debt broker to get the debt from a local bank. Royal Banks, Missouri ended up taking a chance, and it worked out for them. So we were able to do that deal, and it worked out. Yeah. It worked out very well.
Yeah, well, that's good. And you still do business with Royal Banks of Missouri?
I do. Yeah, I have one current loan with them.
Yeah. Okay. Yeah, we've also been a borrower of RBMO, as I like to call them. They're a great bank, and it goes back to the community banking and building relationships and people having local lenders understand the local market and taking a chance on some entrepreneurs. That's great. So this is all 2013.
Correct. So that was all 2013. Yeah. And then 2014, I was focused on the operations of that 64-unit deal. So
one-man show.
Yes, correct. So one-man show, I lived there. The main floor was the leasing office. The townhome I was living in was open for tours all the time. So I kept it clean. Yeah. And I was, aside from leasing and things like that, I was doing the marketing, doing the accounting. I was the maintenance guy. So I was getting calls in the middle of the night because someone got locked out. So I was literally doing everything. And again, at that time, my focus was really on keeping expenses low. I've shifted the way I think. So the focus, we want to control expenses, but the value is really coming from pushing the top line today. But back then, I didn't have the knowledge of how maybe a lender is going to view a deal. If I'm running at 2,500 or 3,000 a unit, a lender is still going to underwrite to 5,000 a unit, for example. So the value is coming from pushing the top line today. But at the time, it was a one-man show. I was working all the time because aside from running that, I was trying to figure out how I can keep growing my company, keep acquiring assets. I knew I didn't have access to any more capital. I don't come from a background where I can make a few phone calls and raise like, a couple $1 million. That's not the case. But, my family put it all on the line for me to do that deal. So I do come from a form of privilege to where, I was put 10, 20 years ahead by being able to tap into that equity. So one thing that really helped me with that first deal, or the first storyboard type of deal in 2014, was the seller, Barry Hayden. And I'm not name dropping because I'm a name dropper. I just want to show gratitude to some of the folks that have helped along the way. So the seller was answering my phone calls like every other day, meeting me like once a week, and he was really helping me out with like any questions I had. So that was a big boost that I don't think I would have gotten in a more challenging or larger market.
Yeah, what I'm realizing based on your story thus far is a lot of things have really worked out, and when there are hiccups, you worked out because you believed in yourself still, and you also had the outside pressure of, my folks believed in me and I'm not going to let them down. I'm going to run through this wall. That's awesome. So in 2014, was that when you founded Storyboard?
Yeah. So the branding was not my priority until more recently. My priority was building a company. Okay. So initially we operated as T.U.T Properties. Okay. A part of that was my relative in Highland. He registered the LLC for me, okay. and he that's the name he used on there, and that's the name that I ran with. So there was no really thought behind the branding and the name in the early years, but that is effectively what became Storyboard. So you could say 2013, 2014 is when Storyboard really started operating. Okay. Even though it was a one-man show until mid 2015. Yeah.
And I can only imagine how draining that would be to, you really had no reprieve. I mean, you were truly a one-man show, and your home was also the show.
Yeah.
Hey, come take a tour. Yeah. Did you let people know, just really quickly, like, oh, this is actually my townhome? Or were you like, oh, this is the model?
Yeah, sometimes. It would depend. If they were dissing the decor, I would say, hey, I live here.
Yeah. That was great. Okay, so 2013 to 2015, and you're really rapidly ratcheting it up. I mean, in terms of, when did you make your first hire?
That was mid 2015. So the way that happened was with this asset, the 64 unit deal in through 2013 through and 2014, I was pushing the top line and controlling the expenses. So there was some value there that was created. I didn't know how to tap into that value, because I was, I was like 23. I didn't have some of the resources I might have today in terms of being able to call people for advice. So I cold emailed like 10 or 15 CEOs of apartment REITs. And in hindsight, I probably should have reached out to like smaller regional companies, but the names I knew were the big names. So I reached out to 10 or 15 CEOs. 3 of them got back to me. One of them, Daniel Drimmer, he's the CEO of Starlight Investments, based out of Toronto. The other one, Bob Dillon, he's the CEO of Main Street Equity out of Calgary, Alberta. And the third one, Steve Evans, he was the CEO of Pure Multifamily REIT out of Vancouver. Okay. So all 3 of them gave me different advice, which was very interesting. So Daniel Drimmer, he's a 3rd generation apartment owner. So his advice was, stop doing the management, hire a third-party management company, and focus on doing deals, which is good advice if you have access to capital. So I didn't have that access or the track record, so that wasn't going to work for me.
Correct.
Yeah, correct. And if I didn't learn the way I learned, I probably would have gotten taken advantage of at some point if I didn't understand the business.
Yeah, and you would have made more mistakes. Very high degree of probability you would have made more mistakes. Yep. They would have been larger mistakes because you're dealing in larger properties. And so you very quickly realized what's working, what isn't working. When you made a mistake, you're like, I'm never going to do that again, right? Yeah. So it helped kind of expedite your growth.
Yeah, I 100% agree with
Yeah.
that. The other advice from Bob was, I resonated with that a little more because his journey was he started fixing and flipping homes, then he started buying small apartment deals and then larger apartment deals, and then eventually bringing in investors and having a publicly traded REIT. So his advice was get your hands on capital any way that you can. Whether it's raising money from people to buy another deal or refinancing this existing deal to buy another deal. So that got me thinking, in terms of being able to refinance, tap into the equity that's been created, and go buy something else. And then the third CEO, Steve, he said something similar, but he also sent me a booklet from at the time Hendrix Berkadia, which today is Berkadia. It was their report on the apartment market, and they had contact info for each office. Yeah. So I sent an email to the St. Louis office of Berkadia. And at the time, now a good friend of mine, Ron Verley, he was kind of leading the debt side of their office. So I reached out to him. I kind of gave him the background on the deal. He sized it up. He took it to the market, sent me a few options, and I was essentially, this was within 18 months, I was going to be able to pull out the invested equity and roll it into another deal, or, pay off my parents, or, whatever the case was going to be. So it looked like a good option to me. We did that. We ended up, there were challenges. It was a CMBS deal.
Okay.
Because I wasn't a permanent resident at the time, so I didn't have options with agency debt. So there were challenges, like in terms of getting to the finish line, but we got to the finish line, pulled out all the equity on that deal within 18 months, and then found a new opportunity founded in early 2015, but closed in about mid 2015.
Okay. And what was the size of that project?
It was 54 units.
Okay.
Kind of a similar play in a way. It was an operational value add. So we do, a lot of our focus is on, we do physical renovations and, the physical value add piece if it's needed. But the operational value add is huge for us. So it's coming in and realizing that vacancies can be marketed better. Your customer service can be done better. And it could be as simple as smiling and answering the phone sometimes. Your maintenance can be better through more rapid communication, responding to things and getting them done in a timely manner, and getting them done right the first time. So that's kind of some of the things I refer to when I say operational value add, and some of it could also be negotiating trash contracts, just making sure you're getting bulk pricing on your materials and things like that. Maybe appealing real estate taxes.
Yeah.
So
insurance, making
right.
sure you're properly insured, but not over-insured, making sure that you have the proper bells and whistles, that you're working with somebody who's going to the broader market, that sort of thing.
Yeah. That's the operational value add in a nutshell. At the time, today we're doing a lot of other things as well, but at the time, some of it was, for example, if a property didn't have a website, or if a property had a family member answering the phone and they only answered it in the mornings 3 days a week or something like that. So the opportunities then look a little different than the opportunities today. But I quickly realized that there's a business plan here if we can find these types of opportunities and continue repeating. So that was a 54 unit deal. And that one, I was able to add value and refinance, I think, within a year.
Wow.
Yeah, it was at the time of closing, it was, I think, 70% occupied. We got it up within 3 months to 100%, pushed rents closer to market. We didn't bring them to market because we wanted the occupancy to go up. But it was a great deal. And every deal, starting from that townhome deal, the 64 unit one, still owned today.
Okay, that's great. So 2013, just really quick recap. 2013, $13,000 mobile home. Still in 2013, you're buying an 8-unit project. 2014, 64 units. Or was that still in 2013?
It was the end, so call
December
it December
2013. Okay, so we'll say 14, 64 units. Within 18 months, you're refinancing, you're cashing out equity, you're keeping the 64 units, and you're adding another 54 units. You're continuing the operational value add, and you're yet to focus on maybe the cosmetic or, really the built environment value add of, granite countertops or updated paint, carpet, flooring, whatever. Okay.
There was a little bit of that with the 54 unit deal. Mm-hmm. So we paved and restriped the parking lot. There was a 1-bedroom apartment that was unfinished, so we finished that out. So there was a little bit of that, but not nearly as much as goes into some of the other deals.
Yeah, sure. And then in 2015 is when you hired the first employee. Correct. Was that a maintenance person or what was that?
Yeah, so his name's Garrett Cummings, and I was very lucky. And you're going to notice a pattern, and you already did notice the pattern of luck playing a big factor in a lot of this. So I was very lucky that I met like the most trustworthy human being you could ever meet as the first company employee or team member. And he's still with the company today, just in a different role. But at the time, he was basically like everything that his role was anything I couldn't do or can't get to.
Your right-hand man. Yeah. You're kind of attached at the hip maybe. And that's really interesting. So you've continued to, we hit on it in the very beginning of, you've built a portfolio in excess of $100 million. So there's a lot of apartment units and self-storage units today. You have a 25-person team. So today, what does Storyboard's setup and, kind of investment criteria look like? Like, how are you unique or what's your competitive advantage? Those sorts of things.
Sure. So our focus and our strategy was refined with every single deal over the last 11 years. Like every single time I'm noticing a pattern of something that's working, not working, and we're, either adding that to the buy box, removing it, whatever the case is. So there are a few assets that we own that were more opportunistic and don't fit with the buy box. But generally speaking, we're buying in the St. Louis MSA, Southern Illinois, Central Missouri. We're looking for 80s or newer vintage. Class B, garden style, townhome style, 40 to 200 units. And we're only buying from either mom and pops or out-of-state owners with third-party management. We don't do any third-party management ourselves. And then we're also looking for deals where we think with conservative underwriting that we can stabilize and have an unlevered yield of about 200 basis points higher than the prevailing debt rates. So that allows us to go in, add value, and then recapitalize the debt and hopefully pull all or most of the cash out. Because we're buying with bank debt, typically when we're going in, the rates are higher. Like today, bank debt might be 7.5, agency debt might be a 6, or in the low 6s. And the bank debt is probably going to have a 25-year amortization. Agency debt will probably be 30 years. You might get some IO. So, there's the ability for you to take on more debt later on and probably have the same mortgage payment. So we're not putting on outrageous amounts of debt to where we feel at least that, it's dangerous to put on the property. And also by that time, you've shown a little bit of a history with the financials as well.
Mm-hmm. Yeah, well, and especially if you're transitioning from a bank loan to the secondary market, whether it's agency, CMBS, life company, then you're transitioning to non-recourse debt, which also removes a portion of removes that contingent liability off your balance sheet. You can sleep a little bit better at night if there is a hiccup. Yeah. But it goes back to our January conversation of one of the reasons we're focused on St. Louis or areas like St. Louis is that cap rates are a bit wider than they are in the coastal markets or the top 5 or 10 gateway markets, which means that you can put more loan-to-value debt, higher loan-to-value debt, but still have a higher cash flow. So your DSCR, your debt service coverage ratio is higher than it otherwise would be, which to me, the cash flow is what matters. It's much less the loan-to-value. Loan-to-value can cycle up and down with cap rates, but cash flow, hopefully, will just continue to rise a little bit.
Agreed. And if I may add to that, a part of what we're doing is we're buying in zip codes. We call it pockets, but it could be a zip code. It could be a neighborhood. It could just be, the other side of the street. But we're buying in pockets that are either growing or stable, even if at a larger level, the county may not be growing,
Right.
for example. St. Clair County is not growing, but everywhere that we are in St. Clair County is either growing or stable. So we're buying in those pockets, and we're buying this Class B 80s or newer vintage asset. And as a result of not having the type of growth you might see in like a St. Charles County or going back to like Nashville, Austin, whatever, we don't have as much competition from new construction. And when we do, their basis is typically going to be much higher than ours. So we have some built-in protection or a built-in moat in terms of our occupancy and rents. Because if we needed to, we probably have the ability to decrease rents. And we've really never had to do that, I don't think. But if we needed to, we could, and we can still be good with our debt cover and all of that.
Yeah. And even if there is a new construction project, to your point, the cost basis is so high, so much higher than your Class B value add acquisition that their minimum rents, I mean, they're really lifting the tide in terms of rental rates. And then it's proving that your property is just that much more affordable. And so there may, over time, even immediately be the ability to increase rates just a little bit, which I think is super helpful. And you're right. I mean,
I definitely love developers. Developers are always pushing the rents further. So I welcome new development.
Yeah, developers, gluttons for punishment. I speak from experience. Yeah, I mean, what else should we know about your competitive advantage? I think is also that everything is in house from the tenant experience perspective. Also, you have a very flat organization. The buck stops with you. You can make decisions very quickly, flat organization. I'm sure you're very open with employees, like, hey, if there's an issue, bring it to me. But with that comes a ton of pressure. And do you ever feel that pressure being, you're not a one-man show, you've got a big team, but being the lead on everything, how do you deal with that?
So it's hard. But a couple of years ago, I really got intentional. This was probably 8 years in, about hiring the best people. I wanted to build an organization that's much bigger than myself. And even today, I don't think we're a large organization, but it's a lot bigger than just myself. So like our director of operations, Steve Kreitzar, he joined about 2 years ago, and he's done an amazing job, a phenomenal job of bringing on the right team members, and then also helping the organization mature to where we have, the systems in place to make it a little less stressful. But you're absolutely right that, we have a flat organization in the sense that, anyone can really reach out to anyone, including myself, if there's a need for it. I didn't really touch on our advantage. So we do have a few advantages that work in our favor and with our broader strategy. So today we're at about 1,000 apartments, and the goal is 3,000, give or take, in the next 5 years. We're not going to buy deals just to buy deals, but I just see an opportunity based on the assets that we've looked at previously or the type of assets that we target. I see an opportunity to get to that 3,000 mark. And our goal is really to roll up these assets that are too small for the larger groups that have a lower cost of capital and package them as a portfolio to trade to the groups that have a lower cost of capital. And this is 5 years to get to that unit count, but I'm talking like a 10-year vision to actually exit and, move into other deals or maybe do the same thing in another part of town. So what we're doing is we're buying the assets and then we're managing in-house. We're vertically integrated. No third-party management, again, because that's a part of our competitive advantage. We're running the assets with central leasing. So you could call and get information on any of our communities. Central maintenance. So our maintenance team operates like a home services company. You come to the headquarters and load up your vehicle, and then you hit the communities you need to hit. And then also shared responsibilities with our portfolio manager, marketing manager, finance manager, who are all awesome people, but just shared responsibilities in terms of it's not like you're only focused on this one property, because the property size that we buy is just not large enough to sustain a full on-site team. And you're nodding your head because I know you're set up in a similar way.
Yeah.
And that's really where we're spotting opportunities to buy, because you don't have, the large player that has everything down to a science buying in this space because they can't operate our assets. When we have, 600 apartments to sell them here and then another 600 in another place and so on and so forth, I think they'll be able to digest the deals at that point. And then, I'm not betting on this, but I also think technology is making access to data and your operations easier every year. It's not easy, but it's becoming easier. I think AI is going to be huge in helping with that as well. So I feel like the smaller deal size 10 years from now is going to be a lot more palatable for a large group to take on. That's just, I'm not betting on it, but it's just a thought.
Yeah. It'll be a huge win if you're right. And if you're slightly incorrect or even totally incorrect, you're going to be just fine, which is a nice place to be. When you started the business in 2013, when you got into the business in 2013, I feel like that was a really good time to get into real estate. So real estate, to me, is really a fixed income investment based off of yields, almost like interest rates, so coupons. And like you said before, there are just so many different levers that you can push-pull to create value or make mistakes, and hopefully you learn from those mistakes. But since the interest rate environment bottomed out in 2020 and maybe Q1 of 2022, Q4 of 2021, now we're at the highest interest rate environment we've seen since we've been alive. How has that changed your ability to continue kind of the rinse repeat aspect of acquisition, renovation, reposition, stabilize, refinance, recoup all of your equity, and then keep going? Are you able to do that today?
So let me just backtrack real quick before I answer that question. That strategy kept repeating until probably 2021. Okay. 2017 was when I paid my family back, and since then I've been, kind of rolling on my own. Yeah. We are able to follow the same strategy to a certain extent. All of our debt is fixed rate. We don't have any floating rate debt. We have one deal we bought in August of 2022 that we're going to do a cash out refi on with Fannie Mae. We're just waiting for the 10-year to cooperate, because if we're locking it in for 10 years, we want it to be a little more favorable. So there's one deal that was bought in a challenging time, and we're refining in a somewhat challenging time that's following the same mold. But I do recognize that, when you're an entrepreneur, when you're in business, you need to pivot and adjust your strategy based on what the market's telling you. So we are pivoting now to a different strategy, to where the deals we're buying today, we're looking at a 2 or 3 year period before we can recapitalize the debt. And then also we're bringing in investors. And the reason for that is, one, we want to grow a larger organization, and it's hard to do on your own. And then two, given the fact that it's going to be harder, in my opinion, to go in and out as quickly, we want to make sure that we're well capitalized and we're able to be conservative with our underwriting and with the debt we place on properties. We have been historically, but being a little more conservative in somewhat of a more trying time, I think, is important.
Sure. And in terms of bringing in the new, welcoming in limited partners to deals, so what's really driving you to do that? Is scale driving you to do that at this point? Or accelerating the scale? Or what is when you woke up that morning and said, you know what, we're going to do this? What was the one thing that clicked in your brain that said it's time?
It's two things. One, spotting the roll-up opportunity and really looking at the deals that I passed on because I didn't have the confidence in getting the equity, and regretting those deals. So spotting the opportunity and rough math, looking at the check size that's going to be needed, and it's not possible without outside investors. And then two, we've attracted some really great team members that are coming from larger organizations, and they joined our company because of the culture, because it's a fast-growing environment, and because they have more autonomy here than in their previous roles. But I feel, and I've asked a few other people about this, and I'd love to get your opinion too. I feel like players want to be in a challenging and exciting environment, and I think growth fuels that. So, I'd love to get your opinion on that as well.
Yeah, I agree with you. I mean, I agree with everything that you said. It's really difficult. To me, the most difficult aspect of our business is talent acquisition and retention, and then ultimately creating an environment where those people thrive, and really just the people management side of the business. I mean, it's really, that's the most challenging aspect for us. And I agree with you. I think we're a little bit within AHM Group, we're unfortunately a little bit behind you. I think you're doing everything the right way, and it's really fun to hear you talk about your thought paradigms, and we want to follow what you're doing. I mean, it's great. I agree with you.
That's a big cosign for anyone that's not familiar. And I know you're being humble there, but I do appreciate it.
Yeah, you're welcome. I don't recall. What was the last question that we talked about? Oh, the challenges. What clicked in your head about bringing in the LP partner?
Yeah.
Did we fully answer that?
Yeah, I don't have a lot more to add there. But I will say that going through this process has opened my eyes. Like I thought I was going in eyes wide open, but I'm really starting to realize what that trade-off looks like now. And we're selective with who we let in, because I'm personally more willing to take risk with my own capital than I am with investor capital. And yeah, it's because I care. I don't want other people to lose their money betting on me, but it's also because I would not be able to sleep if people were calling me and saying, hey, where's, the couple $100,000 I invested with you? Why'd you screw that up? Yeah. So that's a big part of it. And that's selfish in a way, but it's the reality. Like, I wouldn't be able to sleep if people were hating me and calling me like that.
Well, I think that it means that you're a good person. So I think that is how you define being a good person in business, is looking out for all of your stakeholders and the people who are entrusting you. So anything else specifically on Storyboard that I haven't hit on that you think is important for people to know?
We have a goal of becoming the best apartment owner-operator in the Midwest in our space. Yeah. So, that's not to say AHM can't be a better operator in your space, but like in our space in terms of the assets we buy and the strategy we're employing. So all I would say is, if you're listening to this and you want to be a part of a company like that, please reach out to me.
Yeah, it's Raj Tut on Twitter, or X, on all the things. Yeah. So maybe we can move on to just like, what is a typical day at Storyboard Living for Raj? Like, what time do you get up? Like, do you have a very specific routine? What's your life like at work?
Sure. So I've had a goal of getting up at 5:00 every year for like the last 10 years, and I've never been able to achieve it.
Well, same.
So I get up at like 7. Thankfully, my wife Jazz is like, she's the CEO of the house, and she really carries the weight when it comes to like our kids and how amazing they're turning out to be. My daughter Sia is 4, my son Sean is 2. So they're already up and going by the time I get up. I spent some time with them, with our dog Brownie as well. This morning I took Brownie for a walk before doing anything else. Mm-hmm. And then usually I have this. So every single year, as I've pushed the company forward, I've had to grow as a person. I've had to become a better leader. So there's things I do that I know or feel like I shouldn't do that I still do. And one of those things is like going right to my email after. And I've wanted to be able to like, get a workout in and do other stuff before jumping into work. But I just have this thing where I need to know like, okay, what's going on? Is there a problem or a fire I need to help put out? So I do jump right into work after that. And then typically if I'm coming into the office and I'm in the office maybe 2 days a week, I work from home the other days. So if I'm coming into the office, then I'll come to the office later on. But if I'm working from home, I'll try to get a workout in after I make sure, everything is okay. And then I'll jump into work. My days today look different than they did a few years ago because I've been intentional about, bringing in the people that are better than me at their roles. So I was 100% involved in the operations a couple of years ago. Now I'm 20% involved in the day-to-day operations. And I'm more so trying to focus on pushing the company forward. So improvements to operations, new deals. As you know, you have to look at like 100 deals before you see one that might make sense. Relationships, whether it's, brokers, lenders, potential investors now, things like that.
Yeah.
So my days vary. Today, for example, there's a lot of meetings. Our team's great. They handle most of the hiring, but for the key positions, I'll still be involved in like the final interview. So we have a couple final interviews today for an open position. I have a meeting with a potential investment group that's interested in doing business with us. And then it's a lot of that 20% that I mentioned is a lot of just little random things that I haven't taken off my plate yet. So for example, we're closing on a deal next week and we need to figure out the call tree setup.
Oh yeah.
And I'm doing that, right? So it's like a little random thing. And then when those pile up, all of a sudden you have a full day of just random things you need to take care of to keep things moving.
Yeah. A lot of boxes to check off. A lot of to-dos to strike through.
Right.
How do you balance? So you have 2 children. Do you guys plan to have any more?
We don't. No.
Okay, good.
We're good.
We have one son, and he's a lunatic, and so I think we're done. But he's perfect. So are you also intentional in how you balance? It sounds like you are, based off your morning routine, the fact that you are able to work from home. You probably your family sees you throughout the day, even if you're busy, but you're still there. They have this presence. They can probably come and ask dad questions and play with dad every once in a while. But, how do you make time mentally? I think for me, speaking solely for myself, I can be physically there, but I have to be very intentional about being present. And so how do you block the work and your drive? How do you stop that so that you can be there with your family?
I have the same problem that you have. I really do. So I haven't figured it out yet. I do try. And on weekends, for example, I'm not looking at my phone as much as I am during the week. Yeah. So there's stuff that I'll do to make sure that try to make sure I'm in the moment when I'm with my family. But it's a challenge. And one thing that I constantly remind myself of is, they grow up. So my kids, they've grown up so quickly, as, most people will say about their kids. And I just want to make sure that I don't miss out on it. And also that I'm not that parent, once they turn 20, I finally have some free time and they're too busy to spend it with me. So
yeah, they're like, Dad, you're lame. Yeah,
exactly. Yeah, because they think I'm cool at the moment. So yeah, that's one thing that I try to keep in mind. It's tough, but you figure it out.
Yeah, you do figure it out. So your top 3 priorities are family, business, and your health. And I love that business is second to health. I think that actually we're kindred spirits. This conversation is really proving that out to me, because I would say that I have the same priorities. And before I was running or helping to run AHM full time, I was a debt and equity broker at George Smith Partners out in LA, and then Balance Commercial Real Estate, and did a little over $5 billion of transaction volume. And through those few hundred transactions, I noticed a commonality of highly successful people. And that was that, it was really hard for them to turn it off, and they're pretty intense people. And so I just wanted to mention that I thought that it's really interesting that a lot of those people that are very successful would say like, well, health comes later. Like, I'll be fine. Like, I'll be doing work from like the hospital bed or something. So the top 3 goals for your professional life are to build a great business, become somebody that you would look up to as an entrepreneur, and then make sure that you take advantage of the opportunities that you have before you, that maybe other people, your parents and prior generations haven't been able to have. Do you think that the most important part is being somebody that people that are working with and for you, that they look up to you? Like, do you think that's the most important of those 3? Do you think that the other 2 come after that? Like, if you're that person, do they follow? You know, it's like, do what you love and the money will follow.
Yeah. I do agree with that. One thing I would add is I think it's important that our team members, like, whether they look up to me or not, doesn't matter. Just that they respect me. And the way I earn their respect is by creating a great work environment. Mm-hmm. And the way our residents respect our company, you know, hopefully they love it. You know, we don't want them to hate it, but as long as they respect our company, it means we're doing what we need to do on our end to make sure they have a great living experience. So that's the way I feel about it. But another piece, in my opinion, of being a great entrepreneur is taking care of your team, taking care of your customers, and taking care of your family, current and future generations. And once you're at a certain point, taking care of your broader community. So I'm not there yet. I think one day I will be, or I hope I will be. And if I'm not, then if my kids are listening to this in the future, I hope they're, you know, where we need to be as a family in order to do that. But that's the end goal for me. And it's also something that I really resonate with and respect in the business culture in America. You have so many great entrepreneurs that truly invest in their local communities. I personally haven't seen that in a lot of other countries to the extent that we see it here. Even in St. Louis, you know, you can go to the zoo, you can go to the Arch, you can go anywhere, and there's plaques all over the place of, you know, donated by, you know, this person or family or trust or whatever.
Mm-hmm. Yeah, I mean, and that's a great amenity to St. Louis also. I think one of the reasons that so many of our draws to the city, like the zoo and the art museum and Forest Park and all of these things that are great for families in particular, are free because of the business community being able to support it so heavily, and that's great. I agree. I too am trying to find out how I can be more involved, giving back, and you know, I've got some more growing to do in terms of the cash flow situation, right? Before I can write big checks, and until then, I need to figure out how to spend more time doing things that are beneficial to the community and balancing the work, you know, the work-life balance and giving back with my own time. I think, you know, like our time, we just don't, between work. You said it also when we were discussing, you know, before the show or catching up before the show. It's making sure that like you really have 2 priorities in life: your family and work, and there's really not much time else for anything else because it takes all of it.
I would add to that, though, that you're giving back in a way that most people aren't through your work, because you're investing in the city, which is what we all need and what we all want to see, but not everyone's doing. So you're obviously being rewarded for it, but your risk profile is a little different than mine, because you're building something out of nothing in places that need it, in my opinion. So I feel like you're giving back.
I appreciate that, Raj. It's nice to hear that, because, you know, sometimes being a real estate developer can kind of be something that I don't really want to talk to people about that I'm meeting. You know, it's like, oh, the evil guy that's doing these things. So I really appreciate you saying that, and my partners and I see that the same way. So that's how we feel about it also. What's a piece of advice that you would give to the younger version of yourself, say in 2010 or so? You know, like you're in college and you've got a year or 2 before you're going to graduate. What do you tell yourself, or what do you tell somebody in your position?
Yeah, so if it was 2010, I'd say drop out and start trying to buy some real estate. What I would probably have done differently, or I've told myself, was as soon as you're able to start hiring people that are better than you at their particular job, start doing it, because bringing on the right team members is truly an asset, not an expense. I think I waited too long for that. I mentioned this the other day to someone, and his rebuttal was kind of, if you didn't do all the jobs yourself, you wouldn't have known like what it takes, and maybe someone could have taken advantage of you or the company or whatever. So that is a good point, but I think I probably could have grown as a leader a little quicker and started hiring more team members. Sure. And then another piece as well is the self-development. I've always, found information any way that I could. But recently, in the last year and a half, I joined a few organizations, Vistage and Entrepreneurs Organization, that I think have really helped to just being able to not feel as lonely and isolated as, a business owner, and having other people to kind of share some of those struggles with and learn from.
Yeah, that's great. I agree with everything you just said. You're so wise. That's all that I have today. I think this is great. I really appreciate you taking the time. Is there anything that I failed to ask that you would like to contribute?
Well, I just want to say one thing. If anyone's listening to this and they think I think I'm like some real estate whiz or anything, I fully understand. We've had market-driven rent growth, cap rate compression, interest rates going down over the last, up until recently, over the last decade or so. Fully understand that, but I do think we have a unique strategy, and we have a real opportunity to execute on a roll-up that will ultimately be successful for the company and our current and future investors. So we closed on our first deal with investors last month. We have our second deal with investors that we're closing on next week, and then we're gonna pause for a little bit. We're gonna digest those deals.
How many units is that in total between the two?
So one was 96 units.
Okay.
The other is 112 units, and then we're working on a deal. Thank you for the assist. 121 units in Carbondale that we're not going to take investors on because it's too risky.
Yeah.
It's a turnaround type of situation.
Yeah. Student housing deal at a university with, challenging, now it's on the upswing in terms of enrollment, but it went through a challenge. So yeah. So this is proof that, you're riskier with your own capital than you are with those deals that you're going to bring on outside investors.
Yeah, that's true. Risky, but not reckless. Just wanted to say that.
Yeah, I totally understand. Well, that's going to be a great basis too. I think it's a really compelling story. I wish I could take it on because it's pretty close to my hometown. But just geographically speaking, we're not equipped for that in the way that you are. So that's great.
Yeah, no, I appreciate it again. The assist there. We'll call it a hockey assist. They're a great bank to work with, and I'm sure that's why we both have a relationship there. So the only other thing I would mention is we're a growing company. We've been on the Inc. 5000 list and the St. Louis Business Journal Fast 50 list 6 times, and we're going to continue to grow. So if anyone is listening to this that wants to be a part of something like that, with growth comes new opportunities for team members and things like that. Feel free to reach out to me directly.
Yeah.
That's all I'd probably add.
It's not going to be easy probably, but it's going to be fun, right? It's going to be a challenge. It'll be fun. It'll be rewarding, but not easy. So those are the people that you want.
Yep.
Okay. Well, thank you very much. I'll see you next time, maybe. I don't know.
All right. Well, thanks for your time. I appreciate it.
Thank you.